Today we'll be talking about accounting for merchandising operations. Inventory is defined by the standard as current assets held for sales in the ordinary course of business, in the process of production of such sale, or in the form of materials or supplies to be consumed in the production process. In merchandising operations, we have the wholesaler, who is used to only sell to retailers, but now we can buy straight from the wholesaler. Their primary source of revenue is from sales revenue or sales. To measure the profit, sales revenue less cost of goods sold. Cost of goods sold, or COGS, is the total cost of merchandise sold during the period. Therefore, sales revenue less cost of goods sold is equal to gross profit. Gross profit less operating expenses is thus equal to operating profit. We do not have cost of goods sold and gross profit for service businesses. The operating cycle of a merchandising company ordinarily is longer than that of a service company. For services, it tends to be cash, perform service, accounts receivable, and then you receive the cash. However, for merchandising, it starts with cash, buying inventory, merchandising inventory, selling the inventory, accounts receivable, and then receiving the cash. To measure cost of goods sold, begin with beginning inventory, add the cost of goods purchased, minus the cost of goods sold, minus the cost of ending inventory. There are two main types of inventory systems, perpetual and periodic. Perpetual system has widespread use due to technological feasibility. Its most prominent characteristic is merchandise inventory and cost of goods sold accounts are perpetually updated as transactions occur. Inventory records have been up to date. However, you still need to physically count the stock as well in case the records are wrong, missing, or obsolete. Next, we have the periodic system. Most prominent characteristic is merchandising inventory, account, and cost of goods sold are updated at the end of the accounting period, after inventory is counted and costed. Small businesses with low prices and high volume tends to use this method. In other words, revenue is recorded as you make it, but the cost of goods sold are done at the end. This part gets a little bit tricky, so this is inventory in transit. First off, we must be acquainted with FOB, which stands for Freight on Board. FOB shipping point. The buyer pays for freight and insurance. The seller places the goods on the carrier and buyer pays for the freight costs. And ownership swaps between the seller to the buyer at the point of shipping. Ownership swaps from the seller to the buyer when the goods reach the buyer. So for the buyer's perspective, when you buy the inventory, you spend your cash and you increase your asset. The asset to be increased would thus be your inventory. Sometimes you can get your purchase returns if the goods are damaged, not up to spec, or the wrong order. Otherwise, you can get a purchase allowance by keeping the wrong order in your inventory, or if you can get an agreement for cheaper goods. Let's say you bought your inventory on account. You also managed to get a 2% discount rate. You use the discount rate on the accounts payable to find out how much is discounted. The rest is the cash that you are meant to pay. The discounted amount of inventory thus will decrease your inventory account. The buyer's records would look something like this. In our next lecture, we will discuss the perpetual system in more detail.